President Donald Trump has recently pushed for two major initiatives to try to tackle the affordability crisis because inflation obviously raged quite heavily coming out of the COVID lockdowns. And while this year and even last year inflation rates have started to come down, prices are still very elevated, and in certain sectors they continue to rise at a pretty brisk pace. And so Americans are more concerned than ever about affordability, especially given that our society's debt levels are so high now that when you combine the cost of servicing that debt and trying to keep yourself afloat financially with affording these high prices, it's harder than ever to achieve good affordability in the US right now. And so for that reason, the Trump administration, especially in the wake of recent elections where you had people pushing alternative ideologies such as Mamdani in New York, openly running as a democratic socialist and pushing, government handouts and help. I think that the Trump administration is obviously feeling some pressure to try to provide some handouts as well to try to address affordability crisis. So now he's pushing things like a $2,000 check to all people who earn $100,000 or less in the US. And then you also have this idea of 50-year mortgages. And the thought behind these are that, okay, the $2,000 check is going to serve a couple of purposes. One, help with the affordability crisis, but also two, try to boost public political sentiment behind the tariffs that he's trying to push to try to let them know that, hey, this is money reportedly that the government is bringing in from these tariffs that he's sharing with the people to help them afford to live in the United States with the affordability crisis. And then the 50-year mortgage is supposed to help get the market moving. They're also pushing things like assumable mortgages, things like that are going to help make buying a home more affordable, make moving to a new home more affordable, to try to move the housing market more, since it's been pretty much locked into a standstill with high mortgage rates, with people locking in low-term mortgage rates from a few years ago when interest rates were so much lower, not willing to sell their house to move to a new house where they have to pay so much more for a mortgage. So with all that said, while a $2,000 check hitting your account, potentially a lower housing payment, even if it is for a longer period of time, who wouldn't want those things necessarily? I don't think that that's good news at all for the market. I don't think it's good for dividend stocks either. And I think it's leading a lot of dividend investors to be overly complacent in how they're allocating capital right now. And so in the rest of this video, I'm going to dive into what that is and how I'm allocating capital in light of this potential development. Before I get into the content though, if you could please give this video a like, it'd mean a lot to me. Also, if you could subscribe to my channel, you'll get a lot more content, numerous videos a week, deep dive analysis of individual dividend stocks and funds, talking about my dividend investing strategy, my overall portfolio, macro analysis, etc. You'll get a lot of value. And so if you could please subscribe, that'd mean a lot to me. All right, so let's dig into why this is not good news for dividend investors and potentially leading to them making big mistakes in how they're allocating capital. Well, the first big reason is simply the fact that when you hand out $2,000 checks to investors or to individuals, they're likely going to spend that, right? Or at least some of it. They might use some to pay down debt. They might use some to save. But a lot of Americans are just going to use that to spend, to fund their consumer spending. And so that's going to cause inflation. We already tried this drill a number of years ago coming out of COVID. Both parties voted for stimulus checks to the economy, and that unleashed massive inflation. And so my concern is this would only exacerbate the problem. And so what is that going to do? Well, sure, it might help companies to some degree in the short term by boosting in demand for their products. But on the flip side, it's going to cause inflation to rise, which means that long-term interest rates are likely going to move higher. The Fed may not be able to cut rates as much as it otherwise would have. And therefore, with rising interest rates, you're going to have major headwinds for a lot of dividend stocks, because a lot of dividend stocks, for example, like Realty Income is a great example of this. It's almost viewed as a bond proxy because of its long duration cash flows, its high and stable dividend. And so investors, when long-term interest rates rise, bond yields rise, they expect a higher yield out of Realty Income, pushing its stock price lower. And so that's obviously going to be a headwind for a lot of dividend stocks, especially higher yielding ones. And so that's the bad news there. Meanwhile, the 50-year mortgage is also going to have a similar effect in the sense that, one, it will increase potentially demand for housing, which will of course push up inflation. But on the other side of it as well, long duration debt like there's going to be greater demand for long duration debt. And we already have a demand imbalance in the long duration debt markets that's pushing interest rates higher, because the federal government, for example, has been issuing so much debt to fund its huge budget deficit, now around $2 trillion a year, that they are now having to issue enormous amounts of long duration debt into the bond market, which is overwhelming current demand, investor demand for that debt, thereby pushing interest rates higher to attract more investment capital to finance the debt of the federal government. And so adding a whole bunch of 50-year mortgages on top of that is only going to make the problem worse and push interest rates even higher, also serving as a major headwind for dividend stocks. And of course, there are a bunch of other macro factors that are already in place that have been keeping interest rates higher for longer, namely, again, the deficit that I just talked about from the federal government, but we also have major bond buyers of the past are increasingly exiting the market. You have like the Japanese, the Chinese, even the Federal Reserve. Those are all been major U.S. Treasury buyers of the past, and many of them are selling their treasuries, or at least letting them roll off. The Federal Reserve, for example, has been shrinking its balance sheet recently by not reinvesting proceeds from treasury bonds that have matured, instead of just let it roll off their balance sheet to try to shrink the balance sheet and try to fight inflation. But now they've signaled that they're not going to do that anymore, and that they're going to reinvest the proceeds from maturing government debt that they hold. But they're not going to be actively buying more either at this point to be increasing their balance sheet. So it's still not going to be a tailwind, while the Chinese and the Japanese and others are increasingly de-dollarizing. In fact, you see that across central banks across the world are increasingly moving away from US dollars as their main reserve asset, instead of favoring things like gold and other forms of reserves. So that's going to be a headwind continuing for interest rates moving forward. Not only that, but we also have higher structural inflation from several different factors. For example, we have just the demographic change. We have an increasingly aging population. So as the boomer generation, as they increasingly move towards retirement, they're not going to be spending as much money on bonds to build up their savings portfolios. Instead, they're going to be spending down their portfolios to fund their living expenses, give out inheritances, etc. And so they're actually going to be liquidating their bonds rather than adding to their bond holdings moving forward. So that will be a headwind for bond prices and cause potentially long-term interest rates to rise. Additionally, there's such an enormous demand for capital right now due to the decarbonization of the energy grid, and especially due to the AI build out and even the reindustrialization of the US with the deglobalization. Those are all inflationary headwinds and should push interest rates higher, because there's a really high demand for goods and services to build out this infrastructure, the data centers, the energy generation, etc., while also a huge demand for capital to fund those, which is going to, again, bring up the cost of interest rates, because they're going to be looking for long duration debt as well as equity capital, and that's taking capital that would otherwise be going potentially to treasuries, thereby driving up the interest rate to attract more capital in. And of course, with the deglobalization, with tariffs, with breaking up of previous trade flows, costs of goods on aggregate are probably going to be rising, which in turn will equate to higher inflation. So that will also hurt the Fed's ability to cut rates and push long-term interest rates higher to account for that inflation. So when you put all that together, this proposal by President Trump, while it seems to on the surface be addressing the affordability crisis, is likely going to be making interest rates only go higher over the long term. Now, again, this is not a political statement in the sense that it's not a comment on whether I would support President Trump versus the Democrats or anything like that. So, please, this is not a political statement. It's simply just saying I don't think that this policy in particular is going to be useful for dividend investors or really the economy as a whole and solving its main problems. And so investors need to be aware of that. Now, how is that impacting investors today? Well, I've seen a lot of investment analysis on places like Seeking Alpha and even here on YouTube, where a lot of people are saying, hey, Fed is cutting rates, and so therefore I think long-term interest rates are going to come down. And I think that valuation multiples are going to expand on companies like Realty Income or many other REITs and other investment products out there. And so, I think that's a big mistake. And at High Yield Investor, which is my investing group that I run, I encourage you to check it out in the link below, as well as in the pinned comment, where I invest across the high yield space and analyze these stocks closely. We've been warning our members about this for a while, and instead we are focusing on identifying high quality, high yielding companies that also have some pretty strong growth potential. And so that way we're not dependent on valuation multiple expansion. If interest rates remain higher for longer, we can still generate a high return. Now, these opportunities are rare, but they are out there, and you just need to be really selective and really do your due diligence. One of these, for example, that I like a lot right now is Blue Owl Capital. It's an alternative asset manager, has a 6% yield. It's asset light, so it's not really heavily dependent on raising debt capital regularly anyway, and they're growing quite rapidly because of their asset management growth, and particularly they're in the AI infrastructure space with their data center build outs that they're doing. They're able to lease those on long duration terms to companies like Meta and OpenAI, etc. So pretty high quality leading AI company counterparties. So it's a pretty conservative way to play the AI boom, but the assets under management growth that Owl is getting is phenomenal, which should drive, your management expects about a 20% annualized growth rate in earnings per share over the next half decade. Combine that with a 6% yield, and you got a pretty attractive investment setup. Of course, there are risks as with any investment because they are heavily exposed to private credit, which has had some negative headlines recently. Personally, I think it's overblown. Blue Owl Capital's underwriting has been excellent, so I don't think that there are particular risk there. And again, their digital infrastructure business, it could be, it could get hit by if the AI bubble bursts. But again, it's a more conservative way to play it than, say, a Palantir or an NVIDIA. So again, I think as part of a diversified portfolio, I think Blue Owl Capital is a great way to play it. It is so cheap, I think it deserves higher valuation multiple, and falling interest rates should certainly help that. But if those don't manifest, I still think between the yield and the growth, investors, have a pretty attractive setup. Another opportunity I like a lot right now is Brookfield Infrastructure Partners. It's also an infrastructure play like Blue Owl Capital, as its name name implies. It's diversified across midstream, regulated utilities, transportation, that's like ports, shipping containers, railroads, toll roads, etc. And then its data infrastructure business is growing extremely rapidly, and that's data centers, towers, fiber, etc. And so it's well diversified across the infrastructure space. Management and analysts are guiding for a low to mid-teens annualized AFFO per unit growth rate, which you can see there in the graphic below from ticker.com. And if you want to check out ticker.com, they're a great place to get data from analyst consensus estimates for growth and NAV per share and other useful tools for dividend stock analysis. I've got a link with a unique discount code below. You can join through that link in the video description. But anyway, I think that they are a good play because they have around a 5% yield plus that mid-single digit expected growth rate. So again, the price to AFFO multiple they trade at is cheap compared to its history, but they're not dependent on valuation multiples expanding from falling interest rates to still generate an attractive return. So I think they're a pretty good choice as well, again, with a strong balance sheet, good management team. So there you have it. I think that President Trump's initiative, while maybe is positively motivated, maybe it's just a political trick. Regardless, his intent, at least on the surface, is to battle affordability, and it may help put a Band-Aid on the problem in the near term, but I think it's just going to cause inflation to continue to go higher. It's going to cause interest rates to continue going higher. That's going to hurt dividend investors, especially those who are investing with the expectation that valuation multiples are going to expand. So instead of high yield investor, we're being very selective right now, picking names like OWL, BIP, and quite a few others actually we have identified that have strong growth potential and are not as sensitive to interest rates. So if you want to check that out, we are currently offering a 20% limited time Black Friday sale on our pricing. It's very rare that we're able to offer a discount like that these days. And you also have a 30-day money back guarantee. So no risk there to you. You don't lose anything if you don't like it. You can just quit within 30 days and no harm, no foul. Check it out in the link below. With all that said, thank you so much. See you next time.